I think ATR is one of the most useful tools in trading, and one of the most misunderstood. ATR stands for Average True Range, and in plain English, it measures how much a market usually moves over a given period. It does not tell me whether price will go up or down. It tells me how much room the market tends to need. That difference matters, because a lot of bad trading comes from using the wrong tool for the job. The basic idea is simple. ATR looks at the size of recent price movement, including gaps, and turns that into one number. If ATR is high, the market is moving a lot. If ATR is low, the market is quieter. I use that as a reality check. Before I place a stop, set a target, or judge whether a move is meaningful, I want to know whether the current swing is normal or unusually large for that instrument. This is where beginners often make mistakes. They treat ATR like a signal when it is really a context tool. A stock can have a rising ATR and still be falling. A currency pair can have a low ATR and still trend cleanly. ATR does not predict direction. It helps me avoid placing a stop that is so tight it gets hit by normal noise, or so wide that the trade becomes careless. If I know a market typically moves 2 points a day, then a 10-cent stop may be meaningless, and a 5-point target may be unrealistic. Traders use ATR in a few practical ways. The most common is stop placement. Instead of guessing, I can set a stop at a multiple of ATR, often below a recent swing low or above a swing high, so the stop reflects current volatility. Another use is position sizing. If ATR is large, I may reduce size because each share or contract carries more movement risk. ATR also helps with breakout filters. A breakout that happens during very low ATR may be less convincing than one that expands with volatility, because the market is actually showing energy instead of just drifting. The formula itself is not the point, but the logic is worth understanding. ATR is built from the biggest of three ranges: today's high minus low, today's high minus yesterday's close, or today's low minus yesterday's close. That design matters because it captures gaps, not just the candle body. Then those true ranges are averaged over time. In simple terms, ATR is smoothing recent movement, so I can see the market's typical pace instead of reacting to one noisy bar. Where ATR fails is when traders expect it to do more than it can. It does not tell me whether volatility is good or bad, only whether it is present. It can also be misleading during sudden news events because one extreme candle can distort the reading for a while. In thin markets, ATR may understate real execution risk because the chart looks calm even when fills are poor. So I do not use ATR alone. I use it to frame decisions, not to make them for me. My view is simple. ATR is underrated because it is practical, not flashy. It works best when I need to size risk, place stops, or judge whether a move is normal for that market. It works poorly when I ask it to predict direction or replace actual trade structure. If you learn only one thing from ATR, learn this: volatility is part of the trade, not an afterthought. ATR helps me respect that before I press the button.